Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technical and fundamental, driving markets at the moment. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 to 40 minutes or so. We'll follow the usual format, so we'll just check out how markets are trading currently. We'll then look at one of the big themes, which is just this soft landing being consensus now, and really that is igniting this everything rally that we're seeing across different asset classes. And we'll look at some of the stats in the stock markets as well, encouraging stats really for the breadth of the market. We'll then look at some of the technicals on the indices, as well as a couple of favorite stocks, Nvidia, Apple, and Tesla. So some of the charts around those. After that, we'll get into last week's main data points, which were the US PCE, the inflation data out last Friday during the holiday period, of course. We'll then also touch upon some Fed comments from last week, as we do have a host of Fed officials speaking this week as well. Then we'll crack on with this week's main events. So certainly a couple of key risk events in the form of Eurozone inflation data. That's out tomorrow. Check out Eurodollar, of course. Before then, looking at all the US data, we had some ISM data, quite important, that out yesterday. We have the services out tomorrow. Manufacturing, of course, that was yesterday. Services out tomorrow. Lots of then job numbers as well. We have JOLTS numbers out of the US. Job vacancy numbers could be quite interesting today in a couple of hours before of course, the non-farm payroll monthly US employment report on Friday. So a lot to look at. We'll look at the associated currencies with that, and as well, we'll look at gold to wrap up things if we have time. I'm sure we will, which will potentially be affected, of course, by the non-farm payroll report. Okay, markets currently, interestingly, shaping up after the holiday period. I just want to show you, first of all, one major chart that we are looking at the moment, which is the 10-year US Treasury yield. Let me just get that chart up. And I don't want to complicate things too much. This is essentially a global proxy for borrowing costs. So extremely important market for other markets as well. It drives a lot of price action in the dollar, of course, and then is the guide for US interest rates. The 2-year Treasury yield actually is the closer correlation to the Fed funds rate, but the 10-year Treasury yield, as I said, is a global proxy for borrowing costs. So a really important market to look at to then guide other markets. Just before we get to that market, just markets, as I said, at the moment, equities in Asia were mixed, though were higher in Hong Kong, after stronger than estimated Chinese PMI data. Eurostoxx relatively contained. The DAX did push up to new highs before then retracing. Similarly, the FTSE 100 in the UK, that opened up very strongly, actually above 8,000 before also pulling back. If I just check where we are now. Yeah, well, yes, we're still below 8,000 on the UK FTSE, the DAX as well, just in the red, mildly in the red there. So just a slight pullback in European equities. US futures, just checking those out. Actually, they're also in the red. Nasdaq off 0.34%, the S&P off 0.26%, and the Dow also in the red. So those are equity futures for FX. The dollar did strengthen actually and push above 105 yesterday and this morning actually to new cycle highs. But it has just come back and is mildly also in the red. Focus certainly on the Japanese yen and any intervention in that, although we're below 152 at the moment, 151.69 currently trading in dollar yen. Also sterling weakness being highlighted as it dropped below support. which we'll look at shortly as well. Commodities, geopolitical tension certainly lifting commodities. Crude has hit a 5-month high. Also, gold prices, of course, which we'll get into in more detail later on. They hit fresh records, of course. And really interesting, actually, of course, that we had higher yields yesterday, a higher dollar, but then we also had higher gold, which is certainly interesting, potentially due to the holiday liquidity for sure. But even now, we're pushing up in gold, close to that record high, although, as I've mentioned, the dollar has eased off slightly, although treasury yields are higher. It was really yesterday's data, actually, the strong US manufacturing data that lowered US rate cut expectations, really, and they lifted then treasury yields. And we just got this chart here that you can see, which is the 10-year treasury. And if I just take off, I don't want to complicate things too much with so many technical indicators. One of my bugbears is having too many indicators on there. If we just take off a couple, which will leave the black line, which is the 200-day moving average, actually. And then we will just put in this fib level here. Just before I get to that, you can just see this strong dotted line here, which is a key level going back some time, back to autumn in 2022, which is that swing high around 4.33%. And we're just there now again. You can see that acted as quite strong resistance in February and March, and we're just pushing slightly above that now. So really interesting point for us. If we then go back, you can see, well, the fib levels for this move, but if we just go back a touch and put on these indicators, you can just see, if I pull back here, this longer term move from these lows in 2023 up to the highs in 2023. So through the year, really, we have a 38.2 fib level at 4.34%, and that sort of reinforces then this resistance level around 4.33, 4.34% or so on the US 10-year treasury. So yes, just something to look out for, important for us, and especially with these risk events coming up with the jobs data and, of course, then non-farm payroll on Friday. I mentioned about themes, really. Obviously, we're getting into this second quarter, really, whether we get a different theme compared to the first quarter. If you remember, in January, markets priced in almost, well, over 6 rate cuts, really, from the Fed for this year. 6 to 7 rate cuts, 25 basis point rate cuts it was for this year. So a total of nearly over 150 basis points of easing. If you remember at the start of the year, now, interestingly, well, we're actually down below 3 25 basis point cuts. That is priced in by markets around 70 basis points or so. So under the median dot plot, which we saw recently from the Fed, which still had those 3 25 basis point cuts priced in. Markets now just below that. That's been a very rare occurrence. And we have, I've written about it actually previously in our daily commentary and even a week ahead, actually, just about this flip-flopping between rate cut expectations, of course, that we've seen through this year, the first few months. And we, as I've said, we've gone from sort of 150 down to 75 up to 90. And now we're back below 75 pretty much for the first time properly below then the medium dot plot out of the Fed, which was, of course, updated in March from December's, but as I said, kept at those 375, 325 basis point cuts. So interesting. Of course, this sort of confidence in the soft landing has ignited this everything rally, as I said at the top of the webinar. That's really swept stocks, gold, crypto to record highs, really. And also then the dollar has been riding high against virtually every other currency. And then that has sort of put attention on Japan, China, and also India actually to intervene or consider really intervening to bolster their currencies. Really, then it's this shift in the global interest rate cycle, which is interesting going forward with less rate cuts, but certainly then lower yielding assets are really out of favor And of course, it's anything with yield, which is still doing well and continuing to do well. And that sort of defines then this coming quarter that we will see over the next few months. We also get actually the end of quantitative tightening by the Fed potentially as well. And that really potentially puts the sort of idea, and I know there's a few other analysts out there talking about the central bank put even being back again, and then keeping this sort of everything risk rally, stock rally as well from continuing. That, of course, then has all ignited, especially stocks. So we've seen Euro Stoxx 600, Germany's DAX, the Nikkei 225, and other stock indices around the globe really all notching fresh records within the last few weeks or so. The S&P, if we look at that firstly, so the wider benchmark US indices, of course, well-known trend, very strong, bullish trend. Of course, that's notched back-to-back gains over the last couple of weeks, actually, and it closed at an all-time high for the 22nd time this year. Interesting that the succession of record closes really comes as the rally also broadens out. And again, we've been talking about this over the last few months, just the narrow breadth that has been driving stocks, of course, with the Magnificent Seven being key to that. Now, of course, much less talk about those 7 stocks, indeed, with only, I think, around 2, probably 3 of those 7 now up on the year, and the others certainly struggling. Tesla being especially the low light in the original Magnificent Seven, if you like, and other stocks pushing that really out of the top 10 stocks now on the S&P. Just with that breadth, though, 10 of the S&P's 11 sectors are now actually positive year to date. That compares to only 5 at the end of January, for example, 9 at the end of February. And then on, if we look even more in depth at the 500 members or so, 73% of those members now trade in the green on a year-to-date basis. That is up from 45% at the end of January, and actually 60% at the end of February. So clearly momentum is behind this rally, broader number of stocks, higher breadth, if you like, is positive. And potentially, yes, bulls, as we said, bulls, and this trend is still strong. And yes, we shall see how that momentum continues into this quarter, really. I should also say the major US indices as well, those 3, so the S&P, the Dow, the NASDAQ, have chalked up 5 straight monthly gains. We just pull off the chart here. You can see, yeah, 5 monthly gains, and we're just sort of touching now overbought territory, getting into that. Not quite overbought on the RSI there on the monthly after those 5 consecutive months of gains. And we've also had, if we just pull up here, actually, you can just see the consecutive candles that we put on this chart. So the green candles there, consecutive weeks of months of gains on the week. It's just been just sort of very mild pullbacks, and then that continued very strong bullish channel. If we go to the daily, are we rolling over? Potentially not. We did, just checking the RSI here, did we make a, just checking, yeah, we did make recent highs actually on last week. And but we did, so there's slight negative divergence actually on the daily RSI. You can see we made a high a couple of weeks ago, but we haven't made a higher high in the RSI. So interesting that on the S&P 500, otherwise very strong bull trend, as I said, and we're not overbought really. We're just easing off on the RSI actually below 70 now. If we look at the NASDAQ, similar sort of chart, although there is sort of stronger resistance around that previous high from early March at 18,416. We did break above that on the 21st of March. You can see 18,464, the record high, and we've just sort of oscillating, just trading sideways, really. Just below that resistance level around 18,416, as I said, 18,464. That is now a relatively strong resistance zone for us, although we're just tracking sideways, consolidating near the highs, just below the highs, which says to us the longer we track sideways, range contraction, then the more likely we are to have quite strong range expansion at some point, and generally that is in line with the long-term trend. You can see we've got this bull channel in here. Probably should have could have put it on the S&P 500, of course, but I'll just put it on the Nasdaq anyway, just to see this nice series of higher highs, higher lows, and we're still in that channel. Really, I should extend it now, and you can just see, yeah, middle part of that channel, just to the lower middle side. So potentially there would be support around sort of 18,000, I'd call it, pretty much. Nice round number, psychological key number. And that tallies probably with, the cycle high from mid-February, which was just below 18,000. So that's probably decent support. And then that resistance, 18,464, 416 in the Nasdaq. The Dow, again, nice upward channel, although it's sort of slightly more shallow, should I say, than previously at the end of last year, obviously, where we saw that ramp up in buying. So a shallower channel, but still, we're still in there with the record high from the 21st of March, again, just below 40,000. We've got it here, 39,889. Just checking. We haven't broken 40,000 just yet. 39,868 there. But the all-time high we have at 39,889. Might be slightly different if you use a different provider, but yeah, pretty much around that, around the 40,000 level, key psychological level again. And we're not sort of oscillating. We're not tracking sideways as much as the Nasdaq. Interesting, that sort of slightly more volatile. Very small update, and then yesterday we did roll over. We've got initial support there from that previous cycle high in February around 39,282, which tallies with the move lower at the end of March, which was capped, and then we pushed, carried on going north again. So 39,282 is initial support, and then we've got the lower part of this bull channel, which is just above the blue line, which is the 50-day moving average. So around sort of 39,775 is the 50-day moving average. And as I say, the lower part of that bull channel just above that. Okay, those are stocks. I did say actually briefly, and I am going on, but I said we touch upon a couple of favorite stocks as well. So Nvidia, first of all, I'll just try and run through these quickly. Interesting chart for us. We had this bearish engulfing day really at the start of March. On the 8th of March, you can see there, big bearish engulfing candle. So that's where high is above the previous day's high, the low below the previous day's low. So it's fully engulfing the price action on the previous day, and then we close lower. And also we were near the lows of the day. So that generally means that's a bearish sign, but you can see we just tracked sideways again. We held, you can see I've got a fib level in here. There's a sort of minor fib level at 855, and we had held that as support. So that's probably decent support going forward. But again, we pushed up, couldn't quite break those all-time highs at 974. We got to, where did we get to? 967. And then on a closing basis, well, we did break the record high because the close was at 950, but then we've just rolled over since that time and potentially could be in the process of forming, I guess, a double top pattern here. And we probably need a close below, I would say, 825 or so, 825, 830 to confirm that double top. And then what are we, 825 to say 975, so $150 worth of downside possibly if that double top plays out. Of course, still in a decent uptrend. And as I said, we have probably 855 as strong support below to check out initially. Also, Apple, I thought we should look at Apple because, again, interesting levels we're getting to. If we just look at the weekly, you can see this double top pattern potentially forming, which means then we need to hold above key support around this sort of 165.67 level, which is there, which is the low from October of last year. Pretty important cycle low that you can see if I pull back. So potential for a double top as well. And you could see that on the weekly more clearly. Initial support probably from the March lows at 168.49, and then, as I say, key long-term support at 165.67. We probably need to, if we to sort of move higher, we probably need to break this candle here at 178. Above that, prices need to go to then slow and change this downward trend from January, really late January, that we've seen in Apple. Okay, just one other chart, which is Tesla. Obviously performed badly, again poorly compared to the rest of the Magnificent Seven. Again, similar type of chart in a way to Apple. We've got that long-term support level around 152.37 there. And we probably need to get back well above sort of 205. You can see here this area, which tallies with this halfway point of the up move in Tesla, which is at 200 or so. Otherwise, you've got, yes, a fib level at 177, which we're just trying to sort of keep around. But otherwise, if we lose that again, we've got near-term support at that previous March low at 160, and then below that, the 152.37 key long-term support level. Just, yeah, interesting levels for us on a couple of those key stocks that I know everybody likes to look at for sure. Okay, we'll move on now quickly to the US data out of from last week, actually Good Friday. So not sure if many of you were tracking it, but it's the Fed's favored inflation gauge because it tracks a wider basket really of prices compared to the CPI, the Consumer Price Index. So yes, you can see actually this tracking both the US core number and also the blue line is the the core PCE is the blue line, the core CPI is the orange line. Yes, and that came in steady really at 2.8%, the core PCE year on year. That was actually the smallest gain since March 2021, after rising 2.9% in January. So a mild easing really. The monthly underlying inflation data that printed in line actually at 0.3%, slowing from January's upwardly revised 0.5% increase. Just in some of the details, PCE services inflation, so that excluding energy and housing, that gained 0.2% last month after surging 0.7% in January. This so-called supercore increase then 3.3% year on year after rising 3.5% in January. So the price pressures, they are subsiding, but the pace has slowed from the first half of the year. And of course, inflation remains above the Fed's 2% target. If you think about monthly readings, we talk about this quite a lot or have done previously. Generally, you need a monthly reading of around or just below 0.2% over a period of time to bring back inflation to target. So just bear that in mind, of course, with both CPI and PCE, just that 0.2 month-on-month figure really is what the Fed are looking for over a protracted few months to give them even more confidence that inflation is obviously falling back to target. So for this data then, while some of the firmer readings in the CPI basket and also that PPI, so producer price index, the input prices, basically, they weren't replicated in this data due to different weightings. As I've sort of mentioned, some elements of stickiness really remain. And as for Fed Chair Powell, interestingly, actually, after the data on Friday, he said those February figures were kind of more along the lines of what we want to see. That's quoting him, of course. And as I mentioned, the Fed still anticipate 3 rate cuts this year. The first one likely in June. And if we even go back a few weeks ago, of course, Powell reiterated during the the FOMC meeting that he, as I said, wanted greater confidence that inflation was moving sustainably down to its 2% targets before cutting rates. And he acknowledged, of course, that the road to lower inflation could be bumpy. Interestingly, just with the economic projections from the Fed meeting, the committee actually revised up its view on where core PCE will end this year, now forecasting 2.6% versus 2.4% previously, but it kept its 2025 and 2026 views unchanged, and then sees inflation returning to target in 2026. Okay, we also got we had other data, actually, consumer spending that was quite solid, actually, largest gain since January 2023. And that really suggested that consumption likely retained most of the momentum in the first quarter. And in fact, the Atlanta Fed GDP number that actually raised its estimate to 2.3% annualized for this quarter from a 2.1 pace. So that was the main data from last week. We also got comments from the Fed's Waller, sort of relative hawk, really, but his comments got some airtime. He basically said that the labor market is moving towards a better balance, but is still adding jobs at a rapid pace. And then regarding inflation, shorter term inflation measures suggest that progress has slowed or even may have stalled. And he wants to see at least a couple of months of better inflation data, suggesting a further upward drift. Better inflation data before, he has enough confidence that that he would begin to cut rates, and then that would keep the economy on a path to 2% inflation. I should add there are question marks over hope for evidence of this, as base effects really suggest a potential further upward drift in inflation in the next few months. So that potentially puts question marks around the Fed rate cut, of course, in June. We do get a host of other Fed officials speaking, as I mentioned, this week. And markets will be focused on whether officials kind of repeat this more hawkish sort of commentary from Waller, or and especially on the recent disappointing inflation CPI data anyway. So yes, just keep your eyes and ears peeled for some of the commentary and whether they really reiterate those more, as I said, hawkish remarks. Okay, that is the data really from last week. If we move on to this week then, first of all, we'll look at Eurozone inflation. Here's an infographic with all the main data points. We also have one for the non-farm payroll, which we'll get to just after this. But here are the main numbers to watch out for, which are expected in the Eurozone inflation figures. We do get Germany. Did have Germany today. We had Spain last week. But the flash data for the Eurozone, the headline expected to slow to 2.5% from 2.6% previously. And then the core metric, which is the key one for ECB policymakers, that is expected to also nudge down by 0.1% to 3% from 3.1% previously. I've just put in a couple of reasons for potentially what to look out for if you do dive into the data in more depth. I've got Spain CPI in there, of course, which actually rose from February, 3.2 from 2.8%, interestingly, although a lot of this economists are putting down to basically early Easter and then tourism-related services, as well as I've mentioned there. We do get just generally service inflation remaining relatively quite sticky. So sticky, and also some of that strength seems to be broad-based. So that's interesting. Whether that's just a one-off and then we get back, or this tourism boost really gets given back in May, we shall see. From a policy perspective, so from the ECB's perspective, it probably won't be too easy to look through quite a lot of this noise due to Easter, early Easter, the holiday period, etc. So potentially next week's ECB will be a sort of holding meeting. We've heard from President Lagarde, who stated actually in the March meeting that we'll know a lot more in June. And that is the case, of course, with the CPI data and also with wage data, which is really important for services inflation and wage growth, which the ECB has been concerned about previously. We do actually get the ECB minutes from that March meeting out on Thursday. That's obviously when the bank opted to stand pat on rates, of course, as policymakers really continue to monitor progress towards the bank's inflation mandate. Guidance on rates was reaffirmed at that meeting, stating they will be set at sufficiently restrictive levels for as long as necessary. That really served as disappointment, if you remember, to some who had been hoping that the ECB would insert some language suggesting discussions on policy normalization had begun. That really they didn't state. However, the accompanying macro projections, so the staff forecasts, the quarterly staff economic projections, really, they did offer something to the doves, with both 2024 and 2025 inflation forecasts lowered, and leaving the latter matching the bank's 2% target. So for this data, if I just show you a chart as well, that you can see here. Again, core is the blue line, and orange is the headline. Core obviously then excludes those volatile energy, food, tobacco elements. So yes, if we do get a hawkish outturn, we could see a pullback then in some of the recent conviction around a June rate cut, which is now pretty much fully priced in. I think around sort of 90% or so it was when I last looked. And then that could see the market also scale back expectation of easing later in the year, which has, I think, around 25 basis point cuts fully priced in. And well, at the start of the week there was roughly a 50% chance of a fourth rate cut. That has pulled back slightly. So that would be certainly, if we do get stronger than expected numbers, then that will dent the June cut rate cut bet slightly. But obviously, flip side, then figures in line or cooler than expected should then further cement that case for that June cut and potentially hit the euro again some more. If we just look at then the euro dollar chart, which I'm going to get here, just bear with me 1 second. So here we go. Here's the euro dollar chart, which you can see here after really popping up at the start of March, just below 110, 109.81 we got to, and then we just sort of rolled over now, and especially, just pull this up, especially yesterday we saw a sharp move lower, really, below 108 essentially. I've got a few fib levels in here of the Q4 rally, so the halfway point of that rally was at 107.93, tallies with the sort of 108 level. We've moved down now below that quite sharply, and really we're eyeing up then these lows from mid-Feb around 106.94, so just below 107, and just below then the next fib level we have a 107.12, so a sort of support zone there for prices. But certainly the bear trend is quite strong. We would need stronger than expected data really just to give some support to this major and to the euro. If I just pull up the weekly chart, actually, you can just see sort of, if you can see through, well, potentially 4 consecutive weeks now of declines. And yes, just to point out, we're sort of sharply now below these moving averages. The black line is the 200-day moving average, blue line, the 50-day moving average. And the blue line is potentially, just crossing over that 200-day. So potentially a signal there as well for lower prices. As I say, 107 region should act as solid support initially for sure. Okay, that's euro dollar. Obviously, that will be affected by the US data as well. We have had the ISM data. I should recap on that. Quite important manufacturing data that was stronger than expected yesterday. Headline above 50 for the first time since September 2022, 50.3 versus 48.5. So big upside surprise there. And also prices paid, they were stronger, 55.8 versus 55.3 expected. Companies, they also continue to report new order growth with production actually at the fastest pace since May 2022. And that all, as I said, caused rising input costs. And that 55.8 print actually in prices paid was the strongest pace since July 2022. So yes, quite a worry really with also the PMI data that was rising, actually prices rising in the PMI surveys at the fastest pace in 6 months. That's the manufacturing PMI, of course. And those figures as well, they hit a 21-month high when they printed last time and really pointed to quite solid improvement in the manufacturing sector in general. And we haven't seen that, of course, in this area for some months, as I've pointed out, really. So interesting ISM and PMI or the ISM data backing up that PMI data in manufacturing. Just if you can bear with me 1 second, because I've just got a question. Somebody asking about the Bitcoin chart. Yes, I can get to that shortly. If you don't mind, I will definitely get to that. Just bear with me 1 second. I'll just run through the US data quickly. Otherwise, we have ISM services data that's released tomorrow, expected to rise to 52.7 marginally, actually from 52.6 previously. As a comparison, PMI services that eased as well to a 3-month low in March. And really, it's to do with ongoing costs of living pressures, which have been evident. Although I should say confidence as well is rising and actually hit a 22-month high previously. So just mixed data points really as we head into that ISM services data. But costs have increased, certainly due to wage growth, ongoing wage growth, and also rising fuel prices. So as for the job numbers, yes, we get ADP, which is out tomorrow. I should say, it does grab the headlines really, but it really has very little correlation to non-farm payrolls. Should really highlight that fact. We obviously get the weekly initial jobless claims numbers out on Thursday, but then today's JOLT numbers, job openings figures, basically out of the US, could be potentially important. Fed speakers have identified this data as sort of typifying really the sort of excess demand in the labor market, which was seen throughout the pandemic and is now basically reversing. So markets expecting a lower job openings number, but any sharp sort of slowing potentially in the vacancy rates, that would suggest this better balance that policymakers are talking about in the jobs market. And that essentially means less pressure for higher wages and potentially then feeding through into the NFP data that we get going forward. It could potentially, as I say, then be a mover if we do get that sharply slowing vacancy rate, and then potentially that then reverses some of these dollar gains that we have seen late last week and yesterday. Anyway, okay, if I'll just before I get to non-farm payrolls, let's just have a quick look at the Bitcoin chart, which has pulled back. Interestingly, just checking this out. So we again, interesting. We made a higher high in price, but not in the RSI. So you can see negative divergence there, kind of with hindsight. But we could have pointed that out before. So there's negative divergence with the RSI, which didn't make a higher reading. So we got up to obviously 73,835, that record high. And we haven't found resistance there, but we found resistance around, I would say, where 71,789 or so. You can just see prices trying to bump up through that level and didn't quite make it. As I say, always watch out for price action. If we trade sideways, if we trade in a narrow range, then the longer we trade in a narrow range, the longer we trade with range contraction, then the bigger the range expansion will be eventually. As I said, normally that would be in line, with the long-term trend. So you can see here where we've tracked sideways and then pushed higher. And certainly here is a good example in sort of mid-Feb, tracking sideways, narrow ranges, and then this big breakout to the upside in line with the dominant trend. Of course, we haven't seen that recently, and today especially tracking sideways, and then we're just moving lower now. So interesting. Yeah, quite a big move today. And I would say initial support probably around this 50-day moving average looks decent, 62,792. And then certainly we have these lows, from sort of 20th of March around that level, just above 60,000. So sort of tallies with key psychological round number of 60,000 as well. So yeah, that's Bitcoin. Hopefully that's helped with you asking, Samed. Yeah. And hopefully that's answered a question around, price action in Bitcoin for sure. Okay. I'm just double checking actually that you saw what I was talking about. Just bear with me 1 second. Just a slight technical issue. Not sure you saw the chart. Hopefully you did. But yeah, 73,835, that all-time high, of course. Then we had sort of resistance, near-term resistance around 71,789, around that level, tracking sideways, and then just moved down now towards the 50-day moving average, that blue line, which is at 62,789. And then below that, we sort of have around the 60,000 area, which is obviously, as I've said, a key big round number and psychological number as well. Okay, that is Bitcoin. Finally, we'll just move on to non-farm payrolls and just pull up a graphic with all the important numbers that we like to put on this graphic. And also then I'll look at gold as well. Here, you can just see all the main numbers for this report on Friday. Where are we? Consensus view, around 200,000 or so. That may vary slightly with obviously these employment figures we're getting before this report, of course. So at the moment, around 200,000 is consensus for the headline. That is more trend-like rate, or is a more trend-like rate, if you like. And of course, a slowdown from the prior 275. It would also be lower than recent averages. So the 3-month average is at 265, the 6-month average at 231, and the 12-month average pretty similar, 229. So that's just for your guide. We'll be watching the revisions again for sure. They've been very volatile over the last few reports. Actually, in the last one, negative 167, negative 167,000 job revisions, in February and March. And if you sort of equate that with the 275, then it's a sort of effectively a net gain of just only above 100,000 for the headline last time around. Jobless rate, that's expected to remain unchanged at 3.9%. I've put in here what the Fed thinks the jobless rate will be at the end of this year, which is just above that actually now at 4%. They reduced that down by 1/10 in March in the summary of economic projections from December. And the rate of average hourly earnings, so wage growth, really important number. That's expected to pick up actually from the week print in February of 0.1% up to sort of a more normal monthly pace of 0.3%, though the annual rate is forecast to tick 0.2 lower to 4.1 from 4.3%. Employment surveys, they've pointed to a slowdown in hiring. And interestingly, I think around 80% of all jobs added over the last 12 months to 14 months actually have come from just 3 sectors. So yeah, just a sort of interesting bit of detail there. A less robust labour market obviously is the key risk and has been stressed by Powell at the recent March press conference. It was repeated by him as well last Friday. But again, and I think it's important to note, of course, at the Fed press conference, he did say as well that strong job numbers may not be inflationary, so would not necessarily derail rate cuts. Okay, obviously, if we do get, I'm just checking what else, other charts I've got here. I do have, yeah, just a chart showing you the headline number anyway from Reuters, just 200,000 or so. So just a slight slowing from previous few months. Although obviously that picked up from sort of the fourth quarter last year. Also then, I do have, aside from NFP, yeah, just the the FOMC rate cut expectations. The dotted blue line is the median dot plots showing 3, of course, through 2024, so 75 basis points still expected. Then the orange line, I probably should change now because that has dipped slightly below that sort of 75 basis point mark. And what I wanted to show you actually as well, just before I get to this, to gold, is something that we look at, and hopefully you guys may know about it. It's the CME Fed Watch tool. So it's basically a really simple way of looking at Fed funds futures for the particular meeting dates. So I'm just checking you can see that. You can. Hopefully you guys use this already. We've talked about it across virtually every webinar that we do, but when it's certainly interesting, we do. And you can just see, if we just go to May, obviously that definitely no rate cut priced in, or, very minimal 4.3% chance of a rate cut in the May meeting. Everybody's obviously focused on June. And this has been oscillating, as I say. It's now sort of, as you can say, 41% chance that we stay at the or stay unchanged at 5.25 to 5.5%, but then a sort of 59% chance that we do get some sort of rate cut. And I just want to highlight, yeah, so if you look down, you can see 41% is now staying rates as they are. And you can just see even a month ago, even a week ago, that was priced below 30%. So a much sort of higher chance of a rate cut back then. And if we just go to the end of the year, just to show you how markets have changed again, you can just see if we oscillate around 4.5 to 4.75%, which would be 25 basis point cuts effectively, you can see that's now at 33% or so. So a 1 in 3 chance. Hasn't changed a great deal, but then if we go either side, then you can see we're now 17% for 4.25 to 4.5. That was almost double a month ago. And then if we look the other side, so 4.75 to 5%, that's now 30% chance of that happening. Whereas a month ago, it was just a 12% chance of that happening. So you can just see how markets are pricing out rate cuts at the moment, especially on the back of this strong data. Okay, I said I would look at gold, so just bear with me 1 second. I'll just touch on the DXY chart. This is the dollar index, and just to reiterate, again, it's the 6 main trading partners, or some of the major trading partners of the US. But by far the biggest weighting in the DXY, in this USDX index, is the euro, around 56, 57% or so. So, yes, strong weighting, which means if you flip over the euro dollar charts, you kind of get the DXY chart. And you can see then we're just hovering around this previous high just below 105, 104.96, 104.97. Tallies kind of with this fib level of the Q4 sell-off, which is at 104.77. So interesting level of potentially support resistance. We shall see going forward. So that's the DXY chart. We're not overbought in any way. And yeah, just above those previous levels, around 105. I said I'd just quickly look at gold for you guys. And there's not a great deal to say because we keep on, a breakout, interesting breakout, tracking sideways, really, if you like. We did spike higher up to all the twos, 2,222, of course. I did actually write that looked very negative, that candle, but again, we saw buyers, bugs step in, and we obviously had that sharp break through that previous high, and now we've made another new high today at 22.66, but we've just pulled back off that. We are overbought, and we haven't quite made new highs on the RSI potentially, so that's a signal to us. But yes, gold, interesting. Really, yeah, breaking higher, as I mentioned at the top of the webinar, really on with a stronger dollar and stronger yields. So just kind of interesting price action for us with the recent move higher. And also, actually, I was just checking ETF holdings. So this is big investors, massive investment in gold. Those ETF holdings actually continue to kind of not really align with this price action. So ETF holdings continue to actually decline from the start of the year, and over the same time period, of course, gold spot prices really up over 9%. So just again, slight difference in price action with ETF buying. Of course, there's plenty of room for investors to buy the gold market, but potentially we may need to see the Fed actually start cutting rates for really big investors to fully jump into the market. Obviously, we have geopolitical tensions around gold and probably underpinning support for it. And then longer term, we have central bank buying, well known with major central banks, some of the major Asian central banks for sure, diversifying their holdings and looking to buy gold, which they have done through the previous 18 months or so. So yeah, interesting price action in gold. And certainly this may well be affected by non-farm payrolls, which obviously we get on Friday. Okay, I will wrap it up there. It's really great to have you on the call. We've had a lot of people actually today, so really good of you to log in and stay the whole course. Sorry, I've talked for over 50 minutes, so hopefully that's proved of use to you guys. I should mention we've had one question, but going forward, please do ask whatever questions you like. More than happy to answer and look at and give a view on a chart or on some fundamentals that you're looking at, and just have a question about. Please do follow us on social media. And we do, as I said, we write a daily commentary report as well, which gets put on the website as well. Good luck out there. Lots to look forward to in the next few days, of course. And we will speak to you actually next Monday. So we go back to Mondays going forward. And we'll review, of course, all this data as well as look ahead to next week's US CPI data, actually, and also the ECB meeting next week to look forward to. Okay, take care out there, and I'll speak to you very soon.